Welcome to Berman's Call. We are here to take your questions on stocks and ETFs today. Here's how to reach us. 1-855-326-6266. You can email your questions as well. Berman's Call at BNNBloomberg.ca. And Larry joins us in studio today. Good to see you. Thanks for coming in.
Well, last show of the year. So at the end, I'll give my fearless forecast for what might or might not happen in 2026.
Which we look forward to.
It's always fun to also look back and see how well or not I did in last year's call.
Yeah, we'll talk about that in a moment. I wanted to ask about whether or not you think we're finally seeing that Santa Claus rally. Things seemed to turn midweek last week.
We did, and typically the Santa Claus rally is going to be in the last period, like between Christmas and New Year's. On average, something less than 1%. So it's not, makes a lot of headlines, but it really doesn't mean a whole lot. What it does mean, or getting close to, can we hit that magic 7,000 rounding number on the S&P 500? Other than that, and 7,000 means nothing, by the way, other than a round number. But it is something that I'm sure the financial media is going to talk about. I'm getting more and more concerned about valuations, but that's never been a great thing to try to time markets on.
Okay, that being said, even some of the tech is beginning to come back after a November correction, not bouncing back fully, but starting to creep up. What's your take?
Well, when we look at the leadership, there's been technology and the AI in particular. The NASDAQ has not made a new high, where the S&P has come closer and the broader markets have made marginal new highs, even though they failed back into the range recently. So, as we get more expensive on the markets, it's harder for the markets to break out from an already expensive level. So it's a challenge from a trading perspective for those breakout traders out there.
That being said, it'll be a theme for next year, of course. I don't want to get too much into your forecast, but how much of a dominating theme could it be?
Well, Jim Grant's Interest Rate Observer, I've been reading and following for decades, put out a note recently, and they basically looked at the math between the capacity they're building in cloud and compute storage for AI, and they think we're going to be grossly oversupplied in terms of compute, and that is obviously going to be a challenge at some point. Next month? No. Next year? Maybe not. 2 or 3 or 4 or 5 years from now? Very likely. So that's just started to enter the market narrative, part of the recent correction. Are we overinvesting in this area? But that tailwind's still buying dips. And so until that changes, market can continue to grind higher. And the U.S. administration has every need going into the midterm elections to keep the market in good shape and the economy as strong as possible. So I think that's going to be a big part of 2026.
What an interesting metric to look at, how much compute we need and whether or not we're going to be beyond that when the time comes. That must be hard to figure out.
Well, near impossible, because everything's an estimate, right? So when you're estimating the denominator and the numerator, it makes it really tough to be accurate.
Okay, so it could still be a few years out. All right, we'll leave it there. We will start lining up some phone calls and some emails for Larry Berman. Here again is the number to give us a call, as well as the email address, Berman's Call at BNNBloomberg.ca. We're back in just a moment. Welcome back to Berman's Call, here with Larry Berman today to answer your questions. We're going to start with an email from Miraj, who says, "Hi, Larry. Do we have to pay taxes if day trading in a TFSA account?" And I imagine not. That's the whole point of a TFSA account, isn't it?
Well, yes and no.
Uh-oh.
Okay, so if it's predominantly taking up the vast majority of your day and it's the major source of your income, you lose the benefit of the tax shelter. Again, I'm not a tax expert. I've been told this by several people. I would consult on that with a tax expert. But I believe if it becomes the predominant business you're in generating trading, then it becomes not sheltered.
Interesting. So I guess it'll also depend on how they define how much of your income has to be coming from the TFSA and the amount of time you spend
It's
doing
between you and the CRA in terms of how that plays out.
Interesting.
First, they'd have to identify it and audit you, and then not allow your income
from that source. Okay. All right. Let's get to our first caller then. Mark's on the line. He's in Markham, Ontario. Hi, Mark.
Hi. How are you doing?
Good, thanks.
My question is about QBTS. What prompted it to go up today, and is the technology stocks the cause of it as well?
Okay, thank you for the question.
What moves a stock on any given day is typically news. I haven't looked at it today specifically, but if we can bring up a chart, and I see that we have one up here now. About a year ago, I started talking about, we have AI, we have all this, but what about quantum? Mm-hmm. And so quantum computing, and in Canada, QBTS is the go-to play. Mentioned it back in here. Obviously, it's been a huge story. These guys don't make any money yet, right? So it falls into that speculative category. When does quantum become something real? The answer is eventually. Right now, you got to throw this in the speculative category, and it's going to be news focused and driven, and really not core fundamentals. So, with that caveat in mind, you can invest in it. If you look at, are there any analysts really covering these things? And the answer is, from the perspective of the major banks and everything out there, they're just starting to. When you look at where they think the price target is going to be, 30s, 40s is kind of the 14 recommendations fall in that range. So we're in that range now, maybe a little bit more upside. But again, it's speculative. They make no money. Will they someday? Probably. It's one of the leaders in the space out there.
Okay, that was for D-Wave. Let's go to an email from Brian. He's in Bridgewater, Nova Scotia. He says, "Hi, Larry. I've been listening to you recommend private equity and private credit. The problem is access to the platforms, especially with private equity. It requires the investor to be accredited and work through an advisor. I have neither. Is there an alternative avenue to get involved with these investments?" Very good question.
Yeah.
A little technical in nature, but is there?
And so in some cases, yes, where the underlying provider will take clients directly. But unfortunately, because of how these things are distributed, typically not by full prospectus, it does require you to be an accredited investor, which means you've got to pass an income or asset test. And so that's the challenge for the space. So it's firms like mine, for example, at Q Wealth, but then you've got to work with an advisor to get that access to that investment area. I wish it wasn't that way, but it is. But it is the kind of area that's complex. For many people, they could probably understand it. Others may need financial advice when entering the space. But those are some of the things the securities regulators are going to have to weigh in the years ahead as more and more interest in private equity and private credit comes to the marketplace by people like me who are talking about it and others. But there are some providers today, again, that will take clients directly, and the minimums may only be $5,000 kind of
and
thing.
how would you even figure out who they are, who would take on?
I have to stop short of recommending because some of them advertise on the network, and I don't want to play favorites.
But would you know that? Would they advertise that they do take private investors on?
I don't watch the commercials that
not
closely.
Enough. Okay.
I've just seen.
But they're out there. You
names.
have to kind of find them.
Yeah.
All right. Okay. Let's go to our next caller. Guy's on the line. He's in Vancouver. Hi, Guy.
Hi, Larry. 4.5 months ago, you recommended Hecla Mining. I can't thank you enough. I bought it at $6.31, made a 200% profit, and sold it at $18.93. But I've got a little bit of fear of missing out. I wonder if you might have another silver recommendation for us.
Let's talk about the silver run. Is it over?
Boy, I wish that I did. Yeah, Hecla was my favorite pick in the sector. Really like silver. It was lagging for a while, and we've had this monstrous pop. I don't have another, unfortunately, and I don't really play the junior space to know which name, hasn't moved yet. So can't give you that, but thank you for that. It was one of my better calls this year for sure.
Let me ask you, are you still interested in silver next year? Or are you just hanging on to what you have, or are you buying more?
Yeah, so in my fearless forecast, I'm going to talk about precious metals. I think we're going to go higher before we go lower, but when we get into a risk-off environment, I don't think that's coming for a while, but when that happens, these stocks are going to correct, and they're going to correct in a big way, not because of anything else, but money is going to come out of markets because people are going to be scared of an economic downturn. Again, it's out there. It's not the 2026 story, I don't think. So higher before we go lower, but we are starting to enter where these things are getting pretty richly priced.
Okay, let's go to an email then. This one is from Richard from BC. He says, I will be retiring soon. I have no pension, but I do have a pool of money in RRSP, TFSA, and investment accounts. I've been buying covered call ETFs like Evolve Bank and Triple QY, and it's Harvest HHLE, Global ENCL, few others, most sectors covered. The payout on these is about 12 to 17% annually, so it's pretty good income. Do you like the strategy? Are there pitfalls, basically, you want him to be aware of so he doesn't get derailed?
So you don't earn the yield. You earn the total return, no matter whose fund it is and whose product. So what you're getting in a lot of these, I'm not saying all of them, but what you're getting in a lot of them is, because they're getting called away, you're having to replace the security at a higher level. So it's your total return that you earn. You're getting an erosion of your capital in most of them. You're not earning 12 to 17. That's the distribution, but that's not really the total return aspect of it. So that would be my caveat, that you really understand that total return you're getting. Because if you look at the price return of many of these ETFs, you will see the price sort of go down over time, even though they're distributing a lot of yield.
Okay, so that's an overall strategy advice. Is there sort of a caveat for a downfall besides that?
These are intended to be tax-efficient income deliverables, so I like it from that perspective. So if you're in a taxable account, they make a lot of sense. If you're in a registered account and you're bullish on something, you don't need the covered calls. You want to just be long the underlying, because you're going to get better upside performance if you're bullish. So if you're cautious or income-oriented and tax-efficient, the covered call strategies are great in taxable accounts. But if you're directionally bullish, then these aren't the best vehicles to get you the best total return.
Okay. Let's do another email then. This one is from Steve. He says, could I have Larry's outlook for OLY, and is the dividend sustainable? We'll pull up OLY in just a second here and move on from there. So let's talk about Olympia, I guess it is.
So I don't see an income thing in front of me here, so it's hard for me to comment. This is not a name that I follow. I'm a bit at a loss at the moment.
I've got a 6.35 yield for Olympia.
So that's not a terrible yield, but like we saw with others, and if I can use BC as an example, the yield got really, really high, and then they cut it. Really, really high yields as a percentage of what the company earns is a warning sign, because often the company will have to go into debt to sustain those yields. I don't know enough about Olympia to give you that evaluation, so I'm sorry for that, but
what's considered a high yield in comparison to the money
if a company's making 10% return on capital or return on assets, and they're paying out 8%, that's a really high payout relative to what they earn, because if there's a downturn and that 10 goes to 3 or negative, they can't sustain the 8. They can't pay what they don't have, or they have to go into debt to pay it. So you want a lot of coverage on the distribution. The banks in Canada, for example, pay out just less than half of what they earn. But these are really stable, robust earners. So you don't have to worry too much there. But for a company that might have more variability because it's not as big and as robust as some of our great big Canadian banks, then you just have to question that. BC is a big, big company, and they ran into that issue. So when your earnings is not as stable as you would like, again, I can't speak to Olympia because I don't know the underlying.
But is there a number for you as far as percentage yield that makes you go, let me check this out?
70, north of 70, you start asking a lot of questions.
Okay. We are going to take a quick break then. We'll come back with Larry's educational segment in just a moment.
Larry Berman is one of Canada's top technical analysts. He's the co-founder and chief investment officer of Q Wealth Partners. To learn more, visit qwealth.com. Opinions expressed by Larry Berman are his own and do not necessarily reflect the opinions of BNN Bloomberg, its parent company, or affiliates.
Welcome back to Berman's Call. Larry wants to look ahead to 2026 since we are at the end of 2025. Tell us what you expect for next year.
Well, forecasting is very hard. Even the smartest people out there don't know. So, for example, a year ago, we thought it could be a volatile year. So we were right on that concern, certainly in the first half of the year. But the strategists, there were 24 of them last year who forecast. These are top down, right? What's the market going to be at the end of the year? So last year, 6,500 was their forecast. We're about 6,900 right now. The bulls last year were around 7,000. So the more optimistic guys last year were closer to the mark. Where we looked at what earnings were going to be, they were pretty much bang on. So they didn't get the multiple right. But that's really, the best of the best consensus didn't get it right. I could take you back to the great financial crisis and what the forecasts were that year in 2008, and they were 50% wrong because of the crisis. So nobody really knows, but that was last year. What I did say last year was I thought AI would continue to be a bullish factor and that the U.S. would lead the rest of the world. Okay, so let's look at the next chart here. And this is showing 4 ETFs that represent Canada. So Canada, so far in the last few weeks, is the leader in the world. It's just surpassed the emerging markets, Europe, and here's US. So the US market was actually the worst performing so I was wrong about that.
And I imagine you don't see that very often, where the U.S. is the worst performing?
Well, for everything that's AI-led, but it does tell you that value came back in a little bit, and it does tell you that money is recognizing some of the challenges in the U.S., and last year was moving other places in the world. There's currencies embedded in some of these things too, but I'm trying not to sort of consider that at the moment. So that was last year. Let's look at the year ahead. So here's the strategist on the year ahead, and I think there's 28 of them now. So if you look at the year ahead forecast, 9% roughly in terms of growth, roughly 64 is their average price target. Where are the bulls? The top 10 are looking at 77 to a little over 8,000. So they're pretty good. They all think on average, we're going to have really good earnings growth. Why? There's some tax incentives. There's some economic momentum behind us right here, despite all of the volatility last year. And you have the midterm elections. You have policies that are likely going to be forced. Now, we're going to redo the Fed. We're going to have new leadership. There's going to probably be a little bit more easing that's priced into the market. There's going to be every push from the White House and the administration on policy, if possible, to keep the economy strong and the market strong into the U.S. midterm elections, because the polling is pretty weak for the GOP right now and for the White House. So I do think on the policy perspective, this 7,500 is doable. I don't know if it's sustainable, but I think it's doable.
Okay.
When we look at where the fundamentals are, so let's look at the earnings and let's break it down by sector. Because when you look at the sectors and you look at what we've done in 2025 and what they expect for the next couple years, what you see here is the $168 approximately that we earned this year. The growth, 20 to 30% plus annually, is coming from this sector that now represents about 35% of the market. So when you say, what is the market earning overall, you see it's coming largely from tech. So to the extent that tech and AI is leading, these forecasts are likely. If we start to see people worried about AI at some point in 2026, I think you've got to change your outlook. But for now, I think we're going to continue to grind higher. When you look at it from an individual stock perspective and you say, what are the analysts thinking about the price targets 1 year out for each individual stock, and roll that up by market cap, that's giving us 79.38. But that means every stock at the end of the year is going to be at their high. So that's not going to happen. But it does tell you there's a lot of enthusiasm for earnings growth going forward. There's the economic backdrop to back it. So I think that continues in the first half of the year. I'm more concerned about the interest rate markets. I think the long end of the curve is going to have trouble rallying. I think there's tremendous amount of treasury supply, and the market is getting very, very concerned about how are we going to fund all this. And so the yield curve is going to steepen. I think that's a forecast we can look forward to. Short rates coming down a little bit more. The fact that they're pricing the Bank of Canada's next move to be a rate hike, I think, is insane. Because if the economy stays strong next year, we get a couple of rate cuts in the US, 2 or 3, but none in Canada. Maybe 1, but none, probably. And then the hard cliff, because all this pull forward we're going to get next year for CapEx spending doesn't come in 2027. The midterms are over. Trump's a lame duck. Who's controlling Congress and the spending? So that could be a fiscal cliff coming in 2027 and beyond, which would be really, really bad for markets that are pretty exuberantly priced. But I think that that's out there. Now, eventually, the long end responds to that, but probably not in 2026. So, gold, right? Precious metals. People are worried about this fiscal challenge the world has, and gold keeps going higher. We probably hit 5,000 on gold before we correct. But when that liquidity bubble breaks for equities, and we see money rushing into bonds, money is going to come out of Bitcoin, it's going to come out of speculative assets in a big way, and it will come out of gold too. And we'll get a big correction there.
Okay.
So that's the story.
That's the story. Well, we've got it all on tape, so now we know where to look when we need to check. Thanks for coming in. Have a good holiday. We'll see you back here in January.
You as well.
You can connect with Larry in many different ways online. That does it for today's show. Thanks for joining us. The close coming up next.